Welcome to the Commerce Mentorship Program's online lecture series. My name is Richard and I'm the online tutor for Commerce 294, Managerial Accounting. Today we'll be focusing on cost volume profit analysis, also known as CVP Analysis. I will begin by providing you with a brief overview of the subject matter, pointing out key formulas and tips that you will need to succeed in this topic. I will then guide you through some questions relevant to the course material. This is a good time to test your knowledge and understanding of the subject matter. Pause the video before I present the solution and attempt to complete the question on your own. You will know that you have mastered the concepts presented when you are able to complete the questions independently. However, it is good to remember that you should not measure success on this video alone. Accounting requires practice, and the more exercises you are able to complete from your textbook and from your instructor, the higher your likelihood of success in this course. At the end of this video, I will review our goals and objectives for today. Your job is to ensure that you have met each of these objectives and fully understand them. If you have any questions at any time during the video, make a note of it and speak to your instructor or teaching assistant. Not everyone will initially understand the concepts presented today, and you may find that you require some assistance. Do note that this is perfectly natural. By the end of this video, you should be able to calculate a contribution margin, determine a break-even point given total fixed costs and a contribution margin, determine the amount of sales required to achieve a certain after-tax net income, and define and calculate a margin of safety. The concept of a contribution margin will prove to be useful in a variety of management accounting topics. Besides encountering it in CVP analysis, you can expect to see it when preparing segmented income statements and analyzing relevant decision-making scenarios. The idea is actually quite simple. To find a contribution margin, you simply take the total sales or revenue of a company and subtract its variable costs. To calculate contribution margin on a per unit basis, take the selling price per unit and subtract the variable cost per unit. Let's do an example. Soups Galore sells a variety of pre-made stocks and soups. Their best-selling soup, Seafood Chowder, sells for $4 per cup and bears the following costs: $1 per cup of direct labor and $2 per cup of ingredients. Soups Galore sells 10,000 cups of chowder per year. The required here is to determine the contribution margin and the contribution margin per unit. A reminder that you can find the contribution margin by taking the total sales of a company and subtracting its variable costs. In this scenario, Soups Galore sells 10,000 cups of chowder per year for $4 per cup, producing total sales of $40,000. To sell these 10,000 cups of chowder, they must incur $1 of direct labor per cup and $2 of ingredient costs per cup for $10,000 and $20,000. The difference of sales and variable costs is the contribution margin, which in this case is $10,000. On a per unit basis, the selling price of the chowder is $4. With variable costs of $1 for direct labor and $2 for ingredients, the contribution margin ends up being $1 per unit. We will now use our knowledge of contribution margins to help determine another important business concept, the break-even point. The break-even point is the point a firm has to achieve to have its revenues equal its costs. At this point, the firm makes no profit, but it knows that every $1 it produces above this point is profit, and every $1 it loses below this point is a loss. Instructors can ask for a break-even to be presented in three different ways. Number one is a number of units. Number two is an amount of sales dollars. And number three is in a time period, say months, years, or days. If your instructor asks for a break-even point in number of units, simply take the total fixed costs incurred by a firm and divide it by the contribution margin per unit. If you are asked to find the break-even point in amount of sales dollars, take the total fixed costs incurred by the firm and divide it by the contribution margin percentage, which is equal to the contribution margin per unit divided by the selling price per unit. If you are asked how long it will take for a firm to break even, simply take the total fixed costs and divide them by the contribution margin per time period. For example, if you were asked how many months it will take to break even, you would use the contribution margin per month, Whereas if you were asked how many years it will take to break even, you would use the contribution margin per year. Let's do an example. Phonatic is a family restaurant that sells delicious homemade beef noodle soup. With each bowl of soup, they make $15 but incur the following variable costs: $8 of ingredients, $2 of labor required to serve the soup, and $1 of variable overhead. It costs $400,000 for Phonatic to lease their space. Phonatic sells 10,000 bowls of pho per month. The required here is to determine the break-even in units, sales dollars, and number of months. Let's begin with the break-even in units. A reminder that the formula for break-even in units is the total fixed cost of a firm divided by its contribution margin per unit. In this scenario, total fixed costs are equal to the $400,000 lease. In addition, the contribution margin per unit is the $15 selling price subtracted by the $8 in ingredients, $2 in direct labor, and $1 in variable overhead for $4 of contribution margin per unit. If we take the $400,000 fixed cost and divide it by the $4 contribution margin per unit, we are able to determine that it will take 100,000 bowls of pho to break even. Now let's move on to determining the break-even in sales dollars. A reminder that the formula for this is total fixed costs divided by the contribution margin percentage. Total fixed costs are again $400,000. And the contribution margin percentage is found by taking the contribution margin per unit and dividing it by the selling price per unit, which in this case is $4 and $15 respectively. This produces a contribution margin percentage of 0.26 repeater. Using our formula, we find that Phonatic needs to sell $1,500,000 worth of pho to break even. That's $1,500,000. Now let's determine how many months it would take to break even. Again, the formula for this is total fixed costs divided by contribution margin per month, since we want to find out how many months it would take to break even. Total fixed costs are equal to $400,000. And the contribution margin per month is found by taking the $4 contribution margin per bowl of pho and multiplying it by the 10,000 sold per month. This creates a contribution margin of $40,000. Using our formula, we find that it takes 10 months to break even. Another concept we will be covering today is finding the amount of sales required to achieve a certain after-tax net income. We can find the amount of sales dollars to achieve a certain after-tax net income by using the following formula: fixed costs plus bracket desired net income after tax divided by bracket 1 minus the tax rate in decimals bracket all over contribution margin percentage, which we defined as contribution margin per unit divided by the selling price per unit. If tax is not involved, the formula becomes simpler. Simply take the fixed costs, add the desired net income, and divide it by the contribution margin percentage. Let's do an example. Let's Talk More Walk is a family restaurant located beside Phonatic. Focused on serving dim sum 24 hours a day, 7 days a week, Let's Talk More Walk has a contribution margin ratio of 30% and an income tax rate of 20%. Let's Talk More Walk incurs annual fixed costs of $200,000. The required here is to find out how much dim sum Let's Talk More Walk must sell to make an after-tax net income of $25,000. This should be quite simple. We simply keep in mind that there are $200,000 in fixed costs, that we want a desired net income of $25,000, that the tax rate is 20% or 0.20, and that the contribution margin percentage is 30% or 0.30. This generates a required sales figure of approximately $770,833. The last concept we'll be covering today is that of the margin of safety. This is a measure of how far sales figures could change before a net loss would occur. We can find this by finding the number of units over the break-even point expected to be sold, or the number of sales dollars over the break-even point expected to be sold. In other words, the number of units we expect to sell minus the number of units to break even, or the sales dollars we expect to receive minus the sales dollars to break even. This concludes the online tutorial on cost volume profit analysis. Let's review our objectives for today. By now, you should be able to calculate a contribution margin, determine a break-even point given total fixed costs and a contribution margin, determine the amount of sales required to achieve a certain after-tax net income, and define and calculate a margin of safety. Remember that COMM 294 plays-hosted some page or two-page long questions with various twists and turns. Because of this, it is best to skim over a question once before eliminating any values or using any data provided. You may find that you need a value you thought you didn't, or vice versa. For additional problems, please visit us online at cmp.cus.ca. If you have any additional questions, please consult your professor or teaching assistants. Thank you.